Yield to maturity is a measure of yield representing the internal rate of return, the IRR, derived from a bond's price and its anticipated cash flow until maturity. Typically expressed annually, one thing that you always need to know is that all the interest rate that we talk about is always an annual rate. Even just now, previously, the Apple's bond, 1.65%, that is the annual interest rate. But the rate that you are getting, because it's a semi-annual bond, you will divide it by 2. In every 6 months, you will get half of 1.65%. But so whatever it is, we always think of it annually. So this is a thing that you just have to keep in mind. Any interest rate that we talk about is always the annual rate. If not, it's very hard for me to compare other interest rate, right? Because in order to make it simple and as a convention, all interest rates are annualized. And annualized interest rate just means that it is not a compound rate, but you will compound the annual rate. This we will show, probably not today, but eventually we'll show how it works, compound interest, in terms of the annual rate. In order for you to get this yield, like this return, actually yield is more, you think of it in terms of the return. It's not so much the interest rate, it's more the return. You think of it in terms of the return. You only get this particular, okay, remember I was saying the 2% yield. If you get a 2% yield, it just means that you have to have the following condition. Anyway, this 3-point is a little bit hard to explain now. We will explain it in later slides. But just keep in mind these 3 conditions. Okay, we will first follow with an example. I don't know whether you remember, we actually talked about this fictitious company last week. So let's just say that if the 5-year BRWA bond were trading at a price of 101 per USD 100 in face value, so 100 is the par. So 101, just now the examples are all discounted value, which means that the price is below 100. But in this case, it's a premium value, it's 101. So this just means that interest rate actually dropped. The market rate actually dropped. So your coupon rate is actually paying a higher interest rate than the market interest rate, which is why your bond price actually went up. It's priced at a premium. This example, it just says, because if your bond coupon rate is exactly the same as the market rate, it will be priced at par. So when they issue at par, immediately it went up to 101 because the interest rate dropped. So the yield maturity in the following equation, in this case, is a 3.2% annual coupon, but it's paid semi-annually, which means that this is will be divided by 2 or 1.6. Now, so 3.2 divided by 2 will be 1.6 in each of the 10 periods per USD 100 in face value. Because it's a 5-year bond, it did say it's a 5-year bond. Okay, it has to be a 5-year bond because it's paid semi-annually, so you will have 10 periods of payment of 1.6. So this is a 5-year bond. Oh yeah, it did say here it's a 5-year bond, right? So these are all the conditions that needs to be fulfilled before you can say the yield to maturity. Oh, so in this case, it's asking you what is the yield to maturity. So we will have to calculate. So this is the equation. So the yield of maturity is the interest rate R. In this case, you think of it in terms of return because yield is like a return. So what is the return R that you can calculate that is here that will give you a price of 101? Before we actually calculate this, this is I'm surprised that actually a lot of people, they don't really know this, but this is a very quick way of that, this is actually very critical for you to know. Rather than 101, why if this is 100? Why is R here? Like if it's par, it's priced at par 100, why is R here? Like you don't even need to calculate. If people ask you, okay, if the bond is priced at par, then what is the yield to maturity? Like why is R in this case?
0?
No, it's 1.6%, which is the same as the coupon rate. So if the market interest rate is 1.6%, this will automatically be priced at 100. So this is a trick for everybody to know, right? For you and the viewers. So anytime people ask you what is the when it's priced at par, That means the interest rate that you get, the yield to maturity, the return you get, is just the same as the coupon rate. It's 1.6. If this is a premium bond, it's above par, it just means that your yield to maturity is lower than 1.6. If this is a discounted bond, it's below 100, that means R will be higher than 1.6. If it's a expensive bond, if you buy at above par, that means you have to pay, you're getting a lower interest, right? Because you are paying more money upfront. If you are paying at a discount rate, remember just now Apple was saying that you can buy at a lower price, that means your yield to maturity, your return that you get at the end of the day is higher than the coupon rate, which is 1.6. So in this case, if you substitute 1.49% into this equation, you will get 101. So your return is 1.49%. Annual return. Sorry, annual return will be multiplied by 2 because this is a semi-annual. I mean, just for the viewers, we will just 1.49, right? So if you multiply by 2, so you will get a 2.98% return if you hold this bond. Remember, the example was saying that this is a 3.2%. 3.2%. So if you bought this bond at par, you're going to get 3.2% yield to maturity if you hold to maturity. But if you were to buy it at a higher price, your yield to maturity is lower than 3.2%. In this case, it's 2.98% because you're paying a higher price. If you pay a par price, you will get 3.2%. And just now the three condition. Okay, now we can see in terms of the equation. That means that you will hold for this whole time period. That means 5 years. You will hold it 5 years. That means you get every coupon, right? And until the end of the coupon, there's no default, and that you can reinvest it at the yield to maturity. In this case, you'll be getting cash earlier than maturity. So all this cash, in order for you to gain this 1.49 semi-annual rate, which is 1.49 is 2.98%, right? That means you have to reinvest it at the 2.98%. Of course, this is not realistic. You're not going to be able to reinvest it at the same interest rate. But in the sense that they just want you to think that the yield to maturity, you can only strictly get that return only if you are able to reinvest it at the same yield to maturity for all the coupons that you get. I didn't actually explain what this equation is. Okay, so this equation just means that your first coupon that you get is, you need to discount it back. So anything that you get in the future, this is called time value of money. So any money that you get in the future will be worth less now. For example, if I get 1.6 now, $1.6 is actually worth more than I get it a year later. In this case, it's 6 months later. Any coupon that I get in the future, at the present value, the value that I get now is less. So in this case, it will be discounted, right? So this is a positive number. So when you add it, you discount it, it will be a lower value. For example, 1.6, you divide it by 1.0149, right? So it will be 1.58. It will be less than 1.6. And the subsequent coupon, it will be even discounted more because it will be 1.0149. If you square it, it's even more discounting by a bigger value. And at the end of at the 5th year, you will get the coupon plus the principal, the 100 back, and you're discounting back. So if you add all this value to it, the maturity is 1.6%, you will just get $100 back. That means you pay for the bond at $100 par value is basically the fair price because this is the discount rate, right? And the yield to maturity, at the end of the day, if you get all this cash and you invest it, you are actually making a return of about, in this case, it's 1.49%. Okay, before I continue, do you have any question?
1.49% is still annual, right?
Oh no, this one is actually semi-annual. So you have to multiply by 2.
Okay.
But in this case, it's quite misleading. I should have just annualized it. I should have multiplied it by 2. Because whenever you put something like that, if you don't specify that this is semi-annual, it's highly misleading.
So if I put in $100 and then I get $1 back, that's what it means, right? One more extra dollar, 101.
No, you put 101, you only get $100 back.
I put 101, I get $100 back.
You always only get $100 back for a
Okay.
plain vanilla bond, which is why your interest, your yield, your return is lower than 1.6, right? Because at the end of the day, you're paying a higher price for a 1.6% coupon,
Yeah.
but you're only getting 100 back.
But
And
then,
the discount is you still get 100 back. You always
Okay.
get par value back.
okay, but why do I want to do that? If
What do
I
you mean?
get less, right? If I put
Oh,
101,
because you are getting a higher interest rate, 1.6%.
okay. This is
A higher coupon rate.
okay.
Yeah.
Okay.
So
Okay, so the interest part is not in this equation, right?
so the one on the top is the coupon rate.
Yeah.
The interest part is at the bottom,
Okay.
or the return in the sense. When we're doing CFA, we have a special calculator. I can actually show you the calculator. Hold on. We actually have a special calculator, and you can actually calculate the yield to maturity. As you can see, like, how am I going to calculate R in this case? I mean, in math, you have to move this to this over here in order for you to calculate. But this thing has no closed form solution. As in, you cannot take all the R and put it on the left hand side and then to compute it. And and normally in Excel spreadsheet, they have a formula. Deep down, how is it calculated? How is R calculated? Because if I use a calculator, I program it and I say, okay, I put on the coupon rate, the payment, I put in the price, I put in the number of period, and then automatically it will spit out this amount, right, 1.49. But how does it calculate deep down? You want to guess? Like if I have an equation here, right? If I want to find R, this unknown, how do I actually calculate this? This is something that we learned in university, back in school. If you were to do it, how will you do it? Let's say you don't have a special calculator or spreadsheet. You want to find R, how will you do it? You can use trial and error, right? You can roughly guess what is the interest rate. You can put, like, for example, you just put 2%. If the value comes in too low, that means that you have to lower the value, because if the denominator is too high, this value will be highly discounted, right? This will be too low. So it's just an inverse value, right? Remember, like we always say the interest rate and the bond price move in inverse. So you can pretty much use trial and error. If you don't have a special calculator, you can use a trial and error and guess the interest rate. Okay, I'll just review you the answer. You can use Newton's method. Remember, Newton's method is finding the root of an equation. So what you can do is that you can move everything to the one side. If it equals to 0, you're finding the root of because it's like a polynomial. FR will be equals to, just put it equals to 0. So as you can see, okay, so this is the coupon. If this is a semi-annual interest rate, you have to divide it by 2. So this is the sum of the coupon part, not counting the future value, which is 100. So this is the value here. This is the 100 part minus the present value. This is the P. In this case, it's 101. So you just move everything to this function. You put it equal to 0. It's basically finding the root. And I don't know whether you remember the way Newton's method is derived is you can actually use the Taylor series, and then you can just derive it in terms of a recursive method. So you just keep on recurse until it converges to a value. So this is how you can use Newton's method to find R, which pretty much in terms of the computer, how they actually find it is they either use Newton's method or they can use a minimization of the optimization method. I'm just showing this more as for people who are curious to know. You have like an objective function, and you have this sum of squares differences. You just want to minimize this. You want to make this part as close as the value 101 in this case. The P value is 101. You want to make it as close as possible. You want to find the minimum because this is a convex function. So it will be, you have a unique minimum. And this can also be derived from the Taylor series, but in this case, you will need a second derivative. But in this case, it's also Newton's method. You can find it, but you just You just put it in a different way. This is finding the zero of the equation, while this is finding the minimum. Anyway, this is just added information for people who want to understand deep down how you actually find the yield to maturity is you can find using Newton's method. The yield curve is actually a very important concept. I'm sure you heard right now the yield curve is inverted, and an inverted yield curve always signal a potential recession is coming. You always hear in the financial news, they always talk about that. So what exactly is a yield curve? You want to take a guess first? Basically, it's shown here. This is a yield curve. Do you know bonds have different maturity?
Yeah,
right?
yeah.
For example, a government can borrow for like a 5-year bond, a 2-year bond, 1-year bond, 10-year, 20-year, 30-year bond. So all these different maturity, the interest rate would not be the same.
Mm-hmm.
Most of the time, it will not be the same. If this is the maturity, so this is like the lower maturity, and we'll just increment it, right? And the yield to maturity, which is the R, based on the market price of the bond, is like you said before, it depends on the demand and supply, which implies the market interest rate would be a different rate. Now they just look at the government bond for like a 5-year bond and subsequent different year bond. What is the market interest rate now? So they just input the market interest rate to the equation and will give the bond price. So the market interest rate will be the yield to maturity. And different maturity will have a different interest rate. And for normal cases, rising yield curve is considered a normal yield curve. And it will have various different shapes. And remember, the government bonds are always the one that has the lowest interest rate. So any other like corporation will have a credit spread. So a credit spread will be the difference. It will just be a slightly higher or a lot higher depending on the spread. So in this case, a similar 5-year bond for this corporation, this is a fictitious corporation, will have a higher interest rate. And this is the one I have taken on the 30th of May. So this is the government yield curve. Blue one is the current yield curve, while this is just a month ago and this is 6 months ago. As you can see, in normal situation, it's a rising yield curve. As your maturity goes up, the interest rate will go up. But an inverted yield curve just means that it's the other way around. Like when you go higher, the interest rate actually drops. As you can see, it doesn't have a strict drop. It might go up or go down. So this yield curve can have many different shapes. So this is just one of the shape that is right now. And in the future, we will explain why yield curve has a certain shape to it. But for today, I would just say that in the yield curve, it also signifies what the market expects the interest rate to be in the future. In this case, because the short-term interest rate is really high, and the market is anticipating that the interest rate eventually will start coming down, which is why as you head down to the maturity, the interest rate will drop. The yield to maturity will drop. Because the market doesn't foresee that government is going to keep paying a higher interest rate in the future. But this also means that, for example, if you were to hold, say this is like let's just say a 1-year bond. 1-year bond is about 5.3% right, interest. If you were to buy a 10-year bond, it will pay you a lower interest rate. So a lot of people, they find it hard to imagine, so you're telling me that if I buy a 10-year bond, I'm getting a lower coupon rate than I buy a 1-year bond. Then why would I want to buy a 10-year bond then? So a lot of people, they are confused because remember a normal yield curve is a rising yield curve. So you say, oh, okay, a longer maturity, I get paid a higher coupon rate. Okay, that makes sense. But inverted curve, the higher maturity pay a lower interest rate. That doesn't make sense. But it actually does make sense. Why would I want to buy a 10-year bond if I'm getting a higher interest rate for a 1-year bond?
Because you don't know what's going to happen in 10 years, right? The interest rate may drop, right?
Exactly, yes. After 1 year, you roll over to another bond, a 1-year bond, the interest rate will stay at 5.3%.
Yeah.
Yeah, that's probably not the case, right? So unless you want to take the risk, like, because you don't really know what's going to happen in the future, right?
Yeah.
So, so a 10-year bond just means that I've locked in this rate for 10 years.
Mhm.
But a 1-year bond, I only lock in a high interest rate for 1 year. So the next year you will have a reinvestment risk because you don't know what is going to be what's going to happen in the future. So the yield curve actually just tell you that this just means that, okay, if I lock in a 1-year rate, I get a 5.3%. If I lock in the two-year rate, I get a 5%. Right? Say that. So what you can do is let's put it this way. Okay, maybe a 2-year rate, because this 2-year is 5%. I can buy a 10-year rate at 4.7%, or I can buy a 2-year rate at a 5%. And then I'll roll. But in terms of the market forward rate right now, it's just telling you that if you were to roll over another bond, another 2-year bond, it will be a lower interest rate. This is the market pricing forward rate, will be a lower interest rate. It will be lower than 5%. As you can see, this is a lower 4-year rate, right? So if you keep rolling based on the market forward rate, at the end, the 10-year rate will be the similar as this rate. This is basically just telling you that if we were to keep rolling the rate, because it's a falling rate, at the end of the 10-year, you will get this particular rate. What going to happen in the market probably will be very different for what this yield curve is telling you right now. Because this yield curve is just the best guess at what is happening. All the information that I have right now, based on supply and demand, people buying and selling bond, based on all this different rates that they're locking for all these different terms of maturity, this is the best guess yield curve that I have for right now in the market. And I want to lock in. So what they can do is that rather than a 10-year bond, I lock in a 6-year bond. And then from 6 years, then I will just roll at whatever interest rate I have, right? If I believe the interest rate is higher, it's going to be higher than what the forward rate is telling me, that means I can just buy the 6-year bond and I will just sell the 10-year bond, right? I buy the 6-year, I sell the 10-year. And then when the 6-year come, because I believe that the interest rate will go up, then I can buy a 4-year bond at a higher interest rate to fulfill the obligation I have for the 10-year. If you think that the rate is going to be different from what the yield curve is telling, or if you think the interest rate is going to be lower, then you better lock in the higher interest rate now, right? In the 10-year, you lock in this rate because you think that the interest rate is going to go lower. Anyway, so this is how they plot it. Basically, you have all the information here. This is all the market rate, market yield to maturity. And they just plot it in this chart. Okay, I'm going to end here for today.
Okay.
Before that, you have any question?
No, I'm good.